This is Justin Pulitzer. This is my weekend review video for Sunday, February 14th, 2016. Happy Valentine's Day. So the markets are closed on Monday, so I'm going to go a little bit buck wild here with a longer than usual video. I know that a lot of people like it short. Some people ask for it longer. You can just look below in the description if you want to skip ahead or reverse to areas. I usually list the tickers in the order in which I cover them. I know some people have been asking for tabs. I haven't been able to quite figure that out yet, but just take a look in the description and you'll be able to see in the order in which tickers are covered. A couple of other things. I know that there's been a lot of frustration with the clarity of the videos. The resolution, for some reason, when I upload it, takes a while to translate. For that, I have no control over that. That's up to YouTube. These videos are shot on a 5K computer, so the resolution on YouTube will go up to 4K. So they're truly stunningly beautiful if you just take a little bit of time. So if you happen to watch this and you see it in a lower resolution and there's nothing more higher available, just take a couple of minutes, do whatever, and then come back and check it out. The higher resolution will be available. I assure you that they are. It is shot that way, and it should be available that way. Without further delay, let's jump in. I usually like to start this out with the 6 market keys and the 6 Fed keys, although there is an unofficial 7th one that we all know is the S&P. So let's just dive right in. In terms of the VIX, this is relatively new for the last couple of weeks. I created a VIX key. I don't want to waste too much time going over it. You guys can speak English and read, so just take a moment if you want to review this. Just hit the pause button and then pick back up. Now that we're back into it, let's cover the VIX. So VIX, as I've been describing, has been in a period here of lower volatility. There have been some spikes, but in the whole, it's been relatively minor. Here, the pattern sort of looked like it wanted to change, but then we started making lower highs. And now we are doing something a little bit dangerous. We had a breakout of range. This was the flash crash. We came back in, but take a look. We've been making lower highs and kind of now starting to make making higher lows, and now starting to threaten to make higher highs. And all of the moving averages, this is the 200, the 100, the 50, and the 20 are all bent up, and the VIX is kind of looking like it might want to start into a new range with potentially 20 being the low, the 20 being the low and 31 being the high. As you can see over here, I say that 25 and above is crash risk, and over 31 you're probably underway in a crash. So I guess the VIX, I drew in a bit of an up channel here, an unofficial one, just one that I kind of thought made sense. And we've been respecting it for the most part, with a little bit of a look above here and fail, but we did hold it, it did hold this week, and we came back down. However, the Friday close was over 25.20. That, to me, still has crash risk on the table, so the bulls, even with their valiant attempt on Friday, weren't able to close the VIX under the danger zone, so we're still sort of in red light caution here. The 50 held here, so I guess you can say that the 50 MA is the support, and anything above that is still kind of vulnerable. So just keep that in mind when you're thinking about the markets. The potential most dangerous thing to the market, I've said for a while here, is the dollar, the strong dollar. I've drew in some bracket ranges here. Let me just bring us into some more modern times. We're sort of in medieval times here. Maybe 9 months isn't long enough. A year? Is a year good? Yeah, a year is good. Take a look. We've mostly been trading in this bracket for a while. Price action below has been unsustainable. Price action above has been a little bit more stubborn, but also starting to prove a little bit unsustainable. Take a look here. We're starting to make lower highs, lower lows. I guess we can get rid of this line here. This is sort of like a regression line here that I've drawn in, and this was a backside of a prior uptrend. I guess we can get rid of that, although I just want to make a note. sort of is resisting here. We were riding the trend for a while. I'm going to leave that in. You know what? I'm going to leave it in. I'm just going to gray it out because it was useful. And now we are making lower lows off lower highs. However, we are getting kind of close to the lower end of range. And we do have a bit of a abandoned baby type of reversal. This has been a very big pattern in a lot of charts. You can see on this kind of regression line, this bigger picture one held, the backside of that for the most part held. And my fear here is that the dollar is going to kind of rally back up sort of these breakdown levels in the 25s. This was some resistance. It should have been some support. It was a little bit. We broke down and maybe it wants to retest again. But it's good that the dollar is kind of calming down a bit. The problem is that it's still relatively pretty strong. So I had discussed, someone had asked me on the stream about the dollar here. I said below 200 is a short. That turned out to be the case. We'll see. It's supported here. It kind of little bit, it didn't even get a retest here. So I would imagine that it potentially could, but I would like to see the dollar come back down into this range, and then I would say it's probably a right or right out buy. Anything below there would be unsustainable. You could do it with the UUP via selling out of the money puts. The bonds, they have been amazingly strong. I've discussed this at length in past videos, and I'm going to do a little show you. I always talk about the 2009 crash peak. This was the end of the world, keep in mind. And look how strong bonds are right now on a relative basis. I mean, we were almost up to the all-time highs here. So bonds are in a absolute uptrend, a still steeper uptrend, and potentially here in yet another little bit of an uptrend. I probably should draw a uptrend with this, but let's not concern ourselves with that minor detail at the moment. What is important here is I've discussed about the bonds, meaning that lower interest rates, meaning higher bond prices, mean that there should be a higher PE multiple for stocks, because the denominator, this is just pure straight division, there's a numerator and a denominator, and if you have a larger denominator, you have a smaller end product, a lower denominator, or larger end product. The only issue here initially is that this to me is showing panic in the market, meaning people are starting to price in recession. The 10-year got below 2%. That is very dangerous. A lot of countries are playing the game with negative interest rates. Japan did it, for example, and quite the opposite of what they intended to happen happened. They had the yen absolutely strengthen up. They're trying to devalue it, and their markets are absolutely in free fall crash mode. I don't want to show some charts, but if you want to pull up Japan, take a look. There's been some talk about the Fed doing that here. I don't know that they will do that. I don't know how politically how much guts the Fed has to do that here, but it does look like we are at least a momentary inflection point with regard to interest rates. You can see anytime we've kind of gotten these big run-ups, reversal bars, there's been some follow-through to the downside. I would think at the very least we could retest the 20 MA. That was also sort of the body support here in the breakout. So we'll have to see how that plays out. But I do think that this is probably going to want to come down at least to the mid part of the channel, potentially to the channel low. We'll see. I think that the reason for this to have gone up, the reasons for it are still very valid and in place. I don't know that the climate is going to change. I think when people get nervous, they forget about return on their capital and just want a return of their capital. The circumstances for this being up so high, in my opinion, is people in other countries not having the confidence in their banks. We all know what's going on with the European banks. This is just a look at this. I mean, this is absolute free fall. I'll show you this on a longer term basis on a 15-year weekly. This is not a pretty picture, and we are getting close down to the 2011 lows. I did draw a Fibonacci protection off this, and we are at the 1.618, so it doesn't. We actually looked below it a bit. It doesn't surprise me that there was some type of responsive buying there. just on a technical basis. You could also see that was sort of the breakout over this malaise, this kind of chop. So there could be a bounce in these European banks. The one that I've been talking about and the ugly duckling is this Deutsche Bank. Look at this pig. Below the 2008 and 2009 crash lows. I think that a move back up into that area, if you can get into anywhere between the 21, maybe you could get a little higher if there's some type of relief into the 26s or 28s. And that's really where this prior, look at all these supports that were here before. This to me would be an amazing right or right out short. I don't know if we're going to, I mean, that would mean the stock would have to double from here. But this to me wouldn't surprise me if we saw Deutsche Bank in single digits. I know people thought I was a little nuts when I made that call on GoPro, but that did happen. I think we have a momentary reprieve here. 20 MA is going to be very telling, and this sort of breakdown, I mean, this just got a little, I think, a little bit ahead of itself. It got a little bit steep. We are way bombed out on the stochastics, so I would love to see the stochastics do something like rally up, sort of like here. Maybe there is some type of a move to the downtrend line, and then it would set up to be an amazing short. I think this crowd has gotten a little bit overcrowded for the short term, but I do think that Deutsche Bank is signaling there are issues. So that is that. Con Edison also flashing some scary signs. These are the kind of stocks people buy when there are recessions. You could take a look. It's back up. It's making a new all-time high. I think this is getting a little bit ahead of itself in terms of PE. Wouldn't be surprised to see some type of a pullback, but the pullback will likely be buyable. Let's not kid ourselves. Oil is what is driving this market. It is being used as a proxy for global growth. I know that a lot of people talk about more companies use oil as an input than benefit from the sale of oil. And yes, longer term, this is going to be great. Absolutely great for consumers. And you can see that we had a relatively strong consumer confidence number the other day. I've drawn in a downtrend. I've drawn in sort of a support line within the downtrend. We got kind of close to there. We had a hammer low and some responsive buying here. So there might be a little bit more gas in the tank. Look, we've had a few days rally. There might be a few days rally in oil. I think it just got a little bit ahead of itself to the downside. You could see these multiple days down. This kind of selling gets a little bit unsustainable, and we've had these reprieves before, so I guess we're in a little bit of a reprieve. That might be good for the stock market. But down here, there was a rumor, or I shouldn't say a rumor. I mean, it's real. There was a headline out of the UAE, and they said that OPEC is getting close to doing some production cuts. I think there's still a lot of skepticism in that, based until we hear Saudi Arabia say that they're the ones to kind of put the kibosh on. You know, that they're gonna do the cuts. But a lot of these countries, I almost said companies, but a lot of these countries have budgets that are really important to have, you know, higher oil. And I think that what could be happening, and I'm not too big of a conspiracy theory, at least not publicly, but I think that the OPEC might have to make some cuts, and I think it's going to be mostly not because Saudi Arabia. I think Saudi Arabia is looking to make a play. They want to pick up market share. They want to punish the Iranians. You know, these countries have a lot of ideological differences. But I think what's really happening here is that Putin is going to make them make some cuts voluntarily, quote unquote, or else he'll make them mandatory. So that's what I think is going on here with regard to oil. I do think that oil is trying. I mean, I know this sounds so crazy because it just looks like an elevator down, but I do think that we are trying to get into some kind of a bottoming process. You know, when things get the most whippy, that's usually at tops and at bottoms, and maybe we do have some stability coming in. Some of the companies that I've said, you know, my buddy who does the Shadow Trader show, Brad, we were DMing the other day, and he asked me, he said, oh, you know, what do you like in oil? And I told him Exxon. He said, okay, what else do you like in oil? And I said, Exxon. The reason I like Exxon is because they will never, I shouldn't say never. Never is a long time, but it's unlikely these guys will be the last man standing with regard to cutting their dividend. Chevron is probably will be the second last man standing, but you have some reference areas here. You have a reference consolidation here, very whippy one, and we're starting to make some higher lows and starting to kind of make some higher highs. There is some reference resistance up here in the 81s, 82s. So look here, we're starting to kind of break out over these highs. We broke an interim downtrend with some pretty decent conviction. We're back up above the 200-day moving average. However, my one concern here, actually, well, there are many concerns, but look at where this big breakdown took place from. 84.70-ish. The low here, where we kind of tried to find some support, was 82.68. So the last time we had a move back into this area, to these lows, it rejected and we had the pullback. The good news is it's off of a higher low. I do still think that there is going to be some resistance up in here again. On a weekly, though, we did close over the 50-week MA, which is important. Hopefully we could get that start bending back up. The 20 is starting to bend back up. The 200 is still way up here. I think Exxon longer term will go higher. I just don't know that that this breakout is going to be for real this time or for realsies this time, however you want to cut it. I do know that there is a downward regression line here, and that moves on the upside have been unsustainable, as have moves on the downside. So we held it here kind of almost to the tick, and now we have some responsive rallying off of that. This isn't such a conducive market to buying breakouts, but I like buying pullbacks in Exxon. I think that Exxon is one you kind of BTD in. Chevron, same kind of thing, not showing the same relative strength. We haven't broken out above that shelf. But a move above here I do think would be a little bit more powerful. There probably would be some more bounce in your out, so to speak, with this one if you can get back up above these 86s. Particularly this bar. Look at this powerful big candle bar. I think anything above 86.70 would probably have some move maybe to 90. So that's oil. Another big risk-on, risk-off proxy, as we know, is the FXI. This is showing a little bit of, there are some reference, what am I doing here? This is China. Come on, what's going on here? There were some reference lows down here. Looks like we had a bit of a look below and fail, and it's starting to move back up. This is the reference low from the 2009 crash low. Let me just do that live with you guys. Let's take a look. 10 years weekly. No, it wasn't. I'm sorry. It was the 2011 crash low. So look, we snapped the triangle. We filled it up. We got a bit of a look below, actually. So it wouldn't surprise me if there was a little bit of relief. We do have one leg down, two legs down. Usually there's a third. I don't know if we're going to get that. The China, there's a lot of fear in China. They're reopening their markets, I believe, on Monday, I want to say. We're closed on Monday, but they just got over their Chinese New Year. Usually when that happens, growth completely crashes there. We'll have to see how that plays out. So you have a really defined risk trade. I think that the play here to me would be long against the 28.10. If you want to be conservative, you could use this low, the 28.46. Anything above that, the high of day of the 29.10 to me is a long. Anything below the low of the day here is likely a short, because I don't think if you violate these lows again, I think there's another leg down. So that's the deal with them. Some of the other stocks, this BABA has been an absolute pig. We all know that Yahoo is going to be kind of liquidating this stock, so I would imagine that that's going to be under pressure. There are some reference lows down here. I do think that if we could get down to 57.20, that would be a great right or right out type of a buy. I think it's a little late for the short in this, although famous last words, right, as this completely collapses. But we've come down quite a ways here. So I would be thinking that we're sort of, we're on the backside of the prior downtrend here. You can see that's holding. I do think that there's probably a bit of a bounce coming in this stock, but the trend is still down. Maybe we do get a bounce back up to the 66s or the downtrend or the 20 MA. Look what happened here. It rejected here. Maybe there's a move back up, but I think that will set up for another right or right out type of a short. and there aren't earnings, we're below the earnings bar low a day, so maybe there's a move back up, to retest. It just got a little bit extended, but there are no earnings coming up immediately to threaten this. We know the Yahoo pressure is on, so I do think that this is sort of a, if it comes down, faded for a bounce. If it rallies, faded for a short. This was a bullish pattern that should have resolved higher. It resolved lower. You have multiple distributions up here with tons of people who were wrong in this stock, who are just dying to get their money back. Anything to me in these mid to high 60s will set up for a right or right out short. Oh, come on. BIDU. I know this chart is really, it's messy. I admit it. It's a really messy, sloppy chart with multiple time frames of Fibonacci's. You can see you have this one. You could have this one. We are also in a downtrend. I'm a little bummed. We did kind of bounce off of one of the reference lines here. I was hoping we were going to get down to this one ahead of earnings. This is the primary trend line. Maybe we still do. Maybe it rolls over ahead of time. But this is the primary trend line. You could see the body of this flash crash held. I would think that this is a good right or right out type of a buy, particularly if it coincides with 100% of the pullback low. You can see if we kind of retrace there, I would be more interested in buying this than shorting it, although a snap or Ruski on this one probably would have a cascade very quickly down to retest the 100 and maybe even lower. You could even see 86s, as crazy as that sounds. But I'm looking more for a right or right out long on this one for a bounce, particularly if it comes down. If we rally ahead of the earnings to the downtrend, the trade to me is ruined. If we did get up as high as maybe to the top of this volume distribution, I would start thinking right or right, a short for earnings. So it's going to be a kind of a Costanza. We're in a Costanza market. It's a do the opposite type of a situation. IBB, really, really piggish. We had the head and shoulders top, the failed check back. An attempt at a reverse head and shoulders that kind of started forming a cup and handle that completely fell apart. You're below these reference lows. If there was some type of a rally back up to this distribution around the 281 to 285s, I think that that's a short. I want to show you something on a longer term time frame. This is maybe a little too longer term. Let's do 10-year weekly. All right, whatever. This will be fine. Take a look at where we rallied from. You have one leg lower. This is sort of a second. We're kind of in the throes of the last. We have 100% retracement down to 207. If you do a Fibonacci extension with this high and this low, the 1.618 is around 212. I do think there'll be some responsive buying action there for at least a bounce, but the primary trend is a hell of a lot lower. Down in the 136s currently. I don't know if we're going to get, you can see there's some reference lows here. There's a complete, retracement down into the 90s. That really, believe it or not, wouldn't surprise me if we get ourselves into a major bear market, but we are on a 200-week MA. This looks like it's going to hold for a little while, so I think in this area, we could maybe find some support for a bounce, but it sort of looks like we're on the other side of the mountain. There's a lot of symmetry here. It would not surprise me to see us come down to that 200 level. So that's all I have to say about that in terms of Forrest Gump speak. All right, so let's just get into, before we get into the S&P and all that, let's just go through the quick Fed numbers. The Fed, to me, the jobs numbers I've discussed, I think, are terrible. The GDP was raised by the Atlanta Fed, but I think are still terrible. ISMs, both service and manufacturing, have been pretty horrendous. The PMI is horrendous. The durable goods. I want to show you for a minute with durable goods something here with Boeing. This is a pretty interesting chart, and I think is kind of symptomatic for what's going on in the entire broad market. And I want to do this again. I want to get the, no pun intended, because they do make airplanes, but I want to do the 30,000-foot view. If you look at the 2007 top and the 2009 crash low, and you project a 1.618 Fibonacci extension to the top, that's 156.52. It topped out a little bit above there, around 158, and now we are pulling back. We are basically on primary trend. We had a bit of a look below and hold, but it is looking quite vulnerable. So it should be no surprise that technically this was the top out, and then of course we know they cut their 747 production. Now we have the accounting errors or what have you. The path of least resistance always, or I should say the price action always falls along the path of least resistance. If you go from that low to the absolute peak high, let me just adjust this. It didn't snap correctly. 2905. The 61.8 takes you down to this breakout. Look at where these tops were, and look where this run really took place. It wouldn't surprise me to see at least a move to the 50% in the 93s and a potential move all the way down into this volume distribution somewhere in the 70s. That's one way to draw it. There's another way. You could draw the Fibonacci. You could do it from this low. You could do it from this low all the way up here. That would show you that we are right on a 61.8 Fibonacci retracement from this run. So, it's sort of just all in the beehive, it's sort of an art form drawing this stuff in, and no one ever really knows until it's there. It doesn't surprise me, though, that this 61.8 and this primary trend held for at least probably a bounce. Maybe it gets to mid-range here, but there is a hell of a lot of risk if this does snap this low, to me, to come down into this more pressing support here in the 78s. I know it seems like a lot, but if we really truly are in a bear market, it is really possible that we come down into there. Look also, the 2007 highs, also sort of with a bit of a look below into mid-range here, supported. These were these double tops, and then we know what happened. So I don't know if this is sort of, history doesn't repeat exactly, but it kind of rhymes. This was looking like an inverse head and shoulders here, but to me it was really looking toppy, and this is starting to make lower lows. So I'd be a little bit careful with Boeing. I do think that if you want to play it long, it's all right to play against the 102 stop. On the downside, if you lost this, I think that the play is definitely short for a move lower. If you're long, you could use two levels here to me that are important. But I do believe that if you're long, you really got to use that 102 stop. Anything below there to me would get really, really iffy, and it could get really iffy quickly. Keep in mind, this is a big component to durable goods, and it is not looking pretty. The market is the last one, and I will go over that now with regard to SPY. Wow, we are in a long-term pattern here. Let's go into 9 months. All right, so the expected move next week in SPY is $4.71, although I think if it's to the downside, it'll probably be larger than that. So a move up would basically just take you up to 191.34, although keep a look where that is. That is still below the Fed day high. My guess is it would, and when I talk about the Fed day high, I talk about this day. You could see we had double bottoms here, a rally up basically to these resistances, a come back down. You see all these multiple day hammers, a lower high here, and once this snapped, this was sort of a almost like a professional gap lower. We did, however, rally back up. We kind of got to the body lows here and then fell apart, retested these lows. So I'll tell you this, sometimes a market needs to rally before it can sell off. There's a guy who's basically the Vito Corleone of the market profile, this guy Dalton, and he talks about this kind of stuff, about a market needing to rally sometimes before it can sell off. And I think that there was just a lot of there's a lot of reference support down here. You can see all of these lows. Look where these lows lined up. Once those violated, we retested these lows. So the question here is going to be, are we going to do something like this and launch out of this pattern, or are we going to do something like this and then roll over again? I honestly can't tell you. I don't have a crystal ball. All I can tell you is I know probabilities and I know percentages, and I know that we're still a little bit vulnerable. Why? We're below this low, which was 186.93, which coincides roughly with the Fed day low. We're below the Fed day high, and I would say that anything below these hammers to me are still vulnerable. If you want to play long. If you could get back above the 188.34, I would say that this would resolve higher. That's also a 20 MA. It's this reversal day. I think we would rally back up quite strongly, maybe even into the 192s. If this fails and rolls over, it's only showing a move down to 181.92 if you took the measured move. But I believe if you lose these hammers here, these reference lows, we will be an absolute free fall potentially to this reference low, the 173.71, and a 1.618 fib extension of this range down to 172. This, believe it or not, is the primary trend from the 2009 to 2011, those both of the bear market lows. And I think we would see this really, really quickly if we lose these hammers. So I would be shorting below these lows for a potentially even, I don't even know if that honestly would hold because it's so close at this point. I know it's like over $10, but I think that this low, this trend could potentially be in danger if we lost these lows. Look what happened the last time we lost these. That we had this kind of responsive buying, sort of like this kind of rallying here. And then once that was lost, it was a cascade lower to a new range. This could be something identical to this period here. So that rally did. I'm sorry. This period here where we lost it and it kind of tried to rally and then fell. I don't know that that is the case here. I'm just saying that we are still below these two lows and these hammers and this reversal bar and the 20 MA, and I'm pretty damn suspicious. You could put in some other expletives there, but I'm a little suspicious. I think that this had just been a little bit too much too fast. Some expirations, it's, what have you. We are, though, below the one trend line. We do have another one coming here. I do think that this could be tested. This, to me, would be a good right or right out type of a place to buy. So it would be short here, probably cover some here, maybe try a flip long, see how that goes. If we do, like I said, take out this high of day, that reversal bar in the 20 MA, and we're back above the hammer lows, then I think the squeeze is on. I don't know if it's going to be quite this dramatic, but I do think that we would maybe see the range high up into the 190. If we accept back into this distribution, who knows where it ends? Probably somewhere up around the 194, 195. IWM. This one actually was weaker. We took out, this was a bit of a look below and fail and rally back up. I think you could use this low of day here, the 95.19 as a stop. If you're long, it would be below these hammer here, 94.94 to 95.19. Anything below there to me is a short, vulnerable short. Anything above this high of day here is really this high of day. Anything above 93.64 to me is still a long. So you could use this low of day as a stop or as an entry for a short. And if you're long, you could do it anything, you could just stay above anything above that high of day. Really rather simple. I will say this, though. We did have a trend line break, a failed check back, and a move to a lower low. That isn't bullish price action. I'll tell you that. So I'm a little bit more inclined to think that there could be another leg down. I've shown in the past, and I'll show it again, 10-year weekly, the 2007 peak highs. Look at this resistance, and where we launched out of. That has never been retested. I do believe that this area wants to be retested in both the IWM and the SPY. We are quite a ways away from there, although look at this kind of rounded top. I know it's messy because these are my real charts, and this, by the way, is the primary trend and this reference low, which was what I was talking about. However, if that were to snap, this is the 2007 peak down in this area. So that, to me, would be a logical target. I know it seems like a long time away, and I have multiple Fibonacci timeframes on here, and those are not in play at the moment, but I do think that this could be possible. IWM, to me, is signaling that that is not only possible, but actually very likely. I do think that this would be a great right or right out buy for at least a bounce or at least short-term out-of-the-money put sales. IV would probably be pretty jacked if we got down there. Maybe you want to sell these, reference points here. The 76s, or the volume distribution here really is like 78, 79. There's also this reversal peak here. I would think that this body-ish in here, these 75s, this whole area, it's sort of, this area in here to me, these 10 points are going to be the critical ones. It could look deeper into there and then bounce, or it could bounce to the tick, but I would be a put seller, and for a right or right out trade, long at the 85s. Qs. All right, still in a pretty bullish trend, big picture. We are below this box, which I've drawn in. There is reference support here on this past low of 90. I do want to show you one thing, though, that it has me a little bit concerned. This is the 50-week MA, and yeah, we've traded on the wrong side of it a few times, but it's been relatively brief, and we've held trend, and we've basically held this 50-week MA. The 50-week MA here is now starting to slope lower, and we are more significantly below it. The flash crash kind of came to it. We've rejected, came back up, and now we're below it again, and it's starting to roll over. Think about that with regard to FANG. That is very, very key to FANG. These are kind of poor lows. We are still above trend, though. Remember where I said that 90 was some support. Primary trend is a little bit below there. I do have a regression line that I've drawn in. Anything below there has been a little unsustainable. Above here has been stubbornly more sustainable, but longer term not. This is a 61.8. We had a bit of a look below. If we break these 94s, 95s, I think it's going to get kind of fugly down to at least the trend around the 90-91, maybe even retesting the flash crash low in the 85s. If we can take out the high here, this 98.69, I think we'll see the 20 MA, maybe a little bit more. Potentially even the 50 if we kind of recapture some momentum in a few stocks that I'm going to talk about now. Let's just talk about the Big Mac Daddy of them all, which is Apple. I want to show you the relative weakness in this stock and a bigger picture look at what is going on here. I mean, look at this primary trend here was held here. We have a new high. It's sort of looking, I don't know, I want to say head and shoulders-ish, but maybe a little bit. Left shoulder, head, big head, and a right shoulder. This is a key level here. We have a 200-week MA down here around the 92s. You have the flash crash reference low here. If you lose this, I think we see 85, which is the big 61.8 move of this entire move, and primary trend just a little bit below there. Maybe it happens in a couple of weeks from now, and it exactly ties in. But I do think that this area here is going to be challenged potentially on a snap of 92. So if 92 holds, I think we'll rally back up maybe to the 100, fill the gap, maybe even 103 if we're lucky, if the market is bullish. But look where the peak was here. The 2011 peak was 100.72. We're below there. The gap fill here is roughly that, from the earnings and the move down. So I think that anything below this to me is still vulnerable, and anything below 92 is more vulnerable still. Look what happened the last time we peaked. We basically had 100% retracement of the entire run. 100% retracement there would take you to close to 75. I know people are going to say, wow, that's really cray-cray, Justin. It can't happen. I assure you it can happen. And bull markets or bear markets can go a lot further and a lot farther than people think reasonable or possible at the initial onset. It would be basically cutting Apple in half, but it could happen. There's a lot of volume down there. This to me would be an absolute screaming buy somewhere. I don't think it's going back down to 55, but I do think that 85 and 75 are possible. On a plunge down into this area, I will be a put seller. If we got down to this, I would be a share buyer. I don't know why I have two alerts here, but I guess have it to the penny. But I do think down here, There could be an overshoot maybe, but I do think between 85 and 75, 85 and 80, this area, you could play put spreads or put ratios, more like it, catch some of the downside and then get long down into there. So you'd be like buying a put and then selling 2 times as many down into this area. I like that. I think it could play out really well that way. I do think, like I said, that Apple sees 100 again. I just don't know that we don't see lower before higher. If we see up here, then it's a short before a move lower, probably. That's the way I'm playing it. We'll see how it goes. Facebook. Let's get into modern times here. All right, so I've been a really big bull on Facebook for really quite some time. I've drawn in what I call, I was calling this an upward regression line for a while, but there is really no such thing. So I invented another fake word, a progression line, meaning instead of regression, we have progression, a progress. Any move up above there has been unsustainable, as you can see. I don't know why this just drew in. Let me just delete that. Any move above there has been unsustainable. You can see it here. Once again here, no change. Those have followed by pullbacks, chop, pullbacks, chop. This has been the pullback. Maybe we get the chop now. We are still in an uptrend. We have a lot of reference levels here. We did get basically to the middle of this range. 99, anything above 99.24 to me is bullish. I do think it's possible to see down into this level again. I saw the 92s, 93s. We actually looked a little bit below there into the 89s. We had a bit of a shake and bake here. It ran on the earnings. It got the big one of the 61.8s, 1.618, which I drew in there at 116.07. It got above there, and now we are pulling back. This does not surprise me at all. I do think that there will be an opportunity to buy this stock a little bit lower. I don't know if it's going to quite get back down to 86s, but that to me would be a really, anywhere in this area to me is a pretty big screaming buy. The 50 MA with some support. We got below it. Tried to look above it a couple of times. We're below it now. We're on the back side of this. This is an actual regression line, and this did it again. And we ruined the chart. Unbelievable. All right. We'll draw it back in, hopefully correctly. Yep. All right. So we have a regression line here. Draw it back the way we left it before. Just how annoying is that? Wasting time. Anyway, we're holding the backside of it, so I guess you can kind of play long against there. If you're long, you don't really want to see this get back below 100 again, in my view. For sure, not below the 99s. So you could still be long here, although cautious below the 50, in my opinion. And I would say out or short below here for a move back down to trend. So that is what I think about Facebook. I'm long-term bull, but short-term cautious. You can see how this is played out. The consolidation usually leads to a break, and it gets everyone nervous, and then it's a buy. So I don't see any reason for this not to be the same type of a thing. Amazon acting quite piggish. Had a false breakout here, a pretty nasty move down, rallied on Facebook, and now lower. So we're making lower highs with lower lows. We are below the trend with a failed check back at the moment. I actually, believe it or not, am very excited about this because Amazon is a monster. It's a beast. It's a force of nature. I don't really know what other epithets to use. I do think that this will set up for an amazing buy at some point. I just don't know that it won't be lower. This is sort of looking like a bit of a topping pattern. Those tend to like to have big retracements. We're below this trend. This was the kind of the gap and move for the parabolic blow-off-ish. These were the gaps in the breakout above 408.06 and 389. It wouldn't surprise me to see a move back down into there. You can see this was the kind of consolidation before the launch. There was this launch and then this launch. So I do think it's possible to come down there. I don't know if we're going to get 100% retracement, although this to me would be an absolute screaming buy, anywhere between in the low 300s to high 280s. let's see. I mean, I'm not really that bearish, although the market, if we do get one of these really big kind of generational, there seems to be so many generational moves these days, right? I'm so tired of that term. But if we get one of these really big pullbacks, we could see the real primary trend. This was sort of a secondary trend. It really should be in yellow. Being that being the case, we should stay consistent. So we're below that. Maybe we see the primary trend. I would be loading the boat long on a primary trend touch. Let's just keep it that simple. Netflix. A lot of relative weakness in here also. Looking a little double top-ish. We're pulling back. I've said for a while this was sort of the big breakout around 70. I've seen some articles. The 2007 top was 43. I saw one of the papers, I think it was Barron's, who said they thought it was going to 45. I don't know. It's possible. It really is possible. But I would be thinking more, again, a primary trend touch in the 60s maybe. Somewhere I had 63 drawn in here. Maybe it coincides. To me, it would be amazing if it was when we kind of rallied again and then came back down to 70. But I think somewhere in the mid 60s to low 70s is probably going to be the spot. Anything below, let's get it again back into more modern times. Anything below this 93s is vulnerable. I would say 93, maybe even up to 100 if there was a bounce. I think there are a lot of people who bought up here who got, enamored with the story, and now they are a little bit sorry. We're below we actually are above the flash crash low. That was 85.50. So I guess that's your litmus test. If you're still long against 85.50, that's okay, but anything below there to me, it's a GTFO, meaning get the F out. Google is just Google. It likes to do this. It has these consolidations. It just, to me, looks like that. We did get up to the channel high. Maybe we work our way down to the channel low, preferably when it coincides with these old tops. So that's sort of what I'm thinking, that maybe we got to move down there. It wouldn't really even surprise me just to see it do one of these and then shoot up again. But, channel high did hold. We're below the kind of the medium midpoint. We could see a move back up, but anything below this 752.05 to me is vulnerable. 50 is kind of slanting down. The 20 is sort of slanting down. The 100 isn't quite rolled over yet, but I'd be a buyer on the channel low. That's just my feeling. Price line. All right, so you have tweezers, two basically equal bottoms. It is below. This to me was a look below and fail below the reference low. If we go back, let's go back in the way. I don't know if we need the way back, but we're in a little bit of a move back. We are below trend, which is a little disturbing, and we are below. We did get below this reference low. So we're still in a downtrend. Expedia, we know, had good numbers, so that, of course, rallied price line. We are, however, getting close to the backside of the old uptrend and also the breakdown and this consolidation. So I would think between somewhere around this 1100 to, I don't know, in the 1100 somewhere. Maybe it gets to 1150. It's a pretty big move still. It's like a $100 move. But I think that there is a lot of overhead supply now in this, and that this would be. I don't like that this rallied ahead of earnings. I would have preferred this to continue weak, and to set up for a long. Frankly, I was thinking long because you've come down so far, so fast, so low, that it would. I mean, anyone who sold it already sold the bejesus out of the thing. I mean, it's down like 400, almost $500, right? I mean, geez. Wow, that's a lot of points. But. I don't like that we're rallying ahead of the earnings, so to me it's a little bit iffy. But Expedia, sort of the poor man's price line, also kind of came down quite a bit. I was looking for maybe a little bit lower to the primary trend. I was thinking maybe we would get 75. We still may, but it is, it's bouncing. I mean, look how much this has come down already. I mean, these stocks were due for a bit of a bounce and look where they're bouncing to. They're going back basically to breakdown point levels and finding a little bit of resistance. So these stocks to me are still a little bit iffy, I like that Expedia already has their earnings out of the way, and I think you have a very defined level to trade against. Below 99.37 is, I guess, a short below there. You can see you have these reference lows here in the 99s. So if you want to play long against the 99s, that's okay. Or short again, if it breaks there, short. I do think that there could be a move back up here. If you got about half back into somewhere between these reference breakdowns, that to me is likely is probably going to set up short. So that's Expedia. Chipotle, that's another one of these really big stocks. Just reordering here a little bit. I had planned on talking about this a little later. We ran into some 50-day moving average resistance. This did hold trend. It didn't quite get. Maybe I didn't draw it right or whatever, but we got pretty close to trend. You had an old top here at the 44.20. It pressed a little bit below there. So I actually think. I really hope I don't eat these words, but I think Chipotle is kind of is probably a buy. You have a lot of these consolidations. I wouldn't buy it here, but maybe mid-range here, maybe on the 20, around the 458 to 460 level. I think you could kind of play along there, and then if it loses there, just the range low around 445, you kind of have to GTFO because it'll retest these lows and potentially break down. But I'm thinking Chipotle might have a move maybe back up to these breakdowns around the 532. That's sort of what I'm thinking. I don't like chasing the breakout initially, but a mid-range play to me would be okay for a right or right out play. Wow, this one, LinkedIn, holy crap. This thing just got poleaxed. Look at this break. Let me go on a longer term time frame, 5-year weekly. This was in a pretty defined uptrend for quite some time, and the trend broke badly. I think that a lot of people were thinking that there's no reference support levels here, but if you draw a 1.618 fib extension from this range, you get down to 97s. You have a reference low here around 94.75 that basically, fills up the triangle. When you have a triangle snap, a snap of the uptrend, it fills up to where the triangle began. I think that in past videos I've drawn it from here, but I really like this one better. So I do think that there's going to be, also if you drew a channel with this low, somewhere in here there should be some reference support for a right or right out trade. If that loses that level, maybe there's some reference support around 88, but there's really nothing to stop it from going back to the 55s, which is like 100% retracement of the entire move. So short term, I think that this area will find some support. It's also a big volume distribution, but bigger picture, this stock has a lot to prove. If it can hold here, maybe you get some type of a Fibonacci retracement of the bar or back to these reference levels around the 136s. But look what happened here. You knifed through the 166s, you knifed through the 61.8 and the 136s. This is a lot of weakness. There's a lot of damage done in this stock. This is not going to recover so quickly, in my opinion, but I do think down here it's getting a little oversold, and there's probably a right or right out play against this 94.75 stop. Skechers, interesting pattern. You have a lot of reference support here with some higher lows, and now you took out a reversal bar with a very strong close. I want to just show you this on get a little bit closer. I do think that you're breaking a bit of a downtrend. You are still in a primary downtrend, but you're breaking a short-term downtrend. This was the earnings day. This was just an ugly day in the market. This should have really been stronger, in my opinion. I was surprised it closed as weak as it did. But you have a pullback, held the 20, and now closed above this high. So I think you can kind of stay long this versus the low of day as a stop. Just my opinion, will probably get somewhere up to the downtrend eventually. I don't know it's going to be a straight line, but I like this one as a long versus the low of day stop. If you lose that, you probably can reverse short, and it'll retest these lows and maybe finally get back down to these like 20 and 21s. But this is a pretty solid pattern. If you don't want to give it quite as much room to the low a day, definitely the body low, which is in like the mid 28s, mid to high 28s. Excuse me. And I think we'll end on American Express. This is another one that is showing a bit of an abandoned baby bottom. I was really looking for this. I'll show you on a bigger picture time frame. I'm actually surprised we're going to be finishing up as early as we are. We covered a lot of material. Take a look at this. We are at a 2.618 almost Fibonacci projection from this topping range. We had the gap fill. We overshot a little. We overshot this reference low a smidge. Basically mid-range here. I was really looking for a move back down to this area, the 36.93, or more likely. Honestly, I wasn't going to try and play for this, but I would like to have bought this around the 42s to 41s. I don't know if we're going to get that. We do have a bottoming tail hammer here. This is starting to get really, really steep on a premier name. This stock, believe it or not, is trading like 9 times earnings. Yeah, their fundamentals deteriorated some. I get it. People are going digital. I get it. They lost Costco. But for a short-term trade here, this chart pattern to me is looking like it might set up for a long. You can see that we're still in a bit of a wedge downtrend, but I like that you have this low and this is a small bar. So I think there's 2 ways you can play this. You can play this long versus this day's low of day, the 51.64, or you could play long versus the 50.27 low of day. Obviously, a loss of that, we would be reversing short. So this to me is looking like it might want to get up and maybe try to make a run at least to try and fill some of the gap. That's American Express. I wasn't planning on doing WYNN, but I will just because we're not at an hour yet, and I was kind of going to cap this at an hour. Some good news in WYNN. You started to make this look like it was trying, didn't work. Now we are making higher lows and higher highs. You know, really big, strong breakout candle. I would think we at least see the range high into 73, maybe even to 77s. But I think WYNN is trying to bottom. You know, you've had Steve Wynn make some pretty big statement purchases in this stock. This guy has got a lot of money in this stock, obviously, but he's been buying, and I think that the stock is probably back to being a buy the dip stock. I don't know if I would be chasing on breakouts, but I do think that pullbacks here are likely buyable versus trend. So with that, I will end on that. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. You can leave me some comments. You guys help me make the videos better. Be sure to hit the thumbs up, the like button if you liked it. I could always use some encouragement. I am a person too. I have feelings. And I guess unfortunately this video doesn't cover the futures that are going to be open on Sunday or the Monday trade. You know, China could get kind of wacky, either up or down. But this is the analysis that I see as fit for now. That's my story. I'm sticking to it. Let's have a beautiful Valentine's Day and a great rest of the long weekend. And I'll see you next week. Cheers.